information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
Thanks very much for the introduction, Ryan, and thanks for organizing this webinar. And thanks to all the attendees here. As Ryan mentioned, there is time after the session for you to ask questions. I look forward to hearing your questions. I'm here to update you on the health of the overall stock market, fixed income market, and economy, but really happy to address any questions in regards to anything you see here during the presentation or any other off the cuff questions you have. Happy to address those at the end of the session. I'm starting off with the 10-year treasury yield here. As you can see at the bottom of the slide deck, it's moved upwards recently, right? So COVID happened, the interest rates dropped close to zero, the treasury yields dropped close to zero. We're stimulating the economy at that time. And then inflation happened, interest rates came up. Right now, we're seeing it stabilize around 4%. So as of this morning, the 10-year treasury yield is at 4%. That's the key indicator for the fixed income market. If you want to buy a 10-year treasury bond, you will earn 4% for the next 10 years. And that's locked in. That's considered risk-free because it's backed by the US government. This indicator, being the 10-year treasury yield, can move both the fixed income market and also the stock market. When yields rise, bond prices drop. When yields rise, there's more pressure on stocks in terms of their borrowing capabilities. Maybe they could borrow less. The cost of capital is higher. And oftentimes, investors will switch from stocks to bonds when those yields rise. So it's a key indicator for us to monitor in terms of where the return is in the fixed income market, and also the stock market is something we monitor very closely. And you can see that the 10-year treasury yield, even though it's up quite a bit since COVID, it's also up since the quantitative easing programs that we had. I'll get more into that later on. But since the financial crisis of 2008, yields have been low for a very long time. It's up from that time period, but it's still lower compared to the average going back to 1960. So this slide goes back to 1960. You see the average 10-year treasury yield is at 5.8%. We're at 4%. And that impacts your decision to buy a new home. You have to take out a mortgage. This interest rate will move that mortgage rate. And we'll talk about the housing market in a little bit as well. So moving on from this slide to the next slide, we see the stock market returns. This is the S&P 500 index, right? So you saw it went down in April. That was due to the trade war that we had announced in April. A lot of uncertainty for the economy, a lot of uncertainty for the stock market. Stocks took a hit there in April. You may remember the news back in April was a lot of it was on China and tariffs and reciprocatory tariffs. That's still in the news today. But we saw the impact and the shock effect in April in terms of the uncertainty that would come with that and how that would impact trade, impact the economy and GDP growth, and how that would impact the stock market. So the stock market went down. The stock market is a leading economic indicator for the economy. And given the uncertainty tariffs posed to the economy, the stock market went down in April, but it's bounced right back up. And it's really been on a tear ever since. So looking at the stock market, we can see that it's done well over the past year. And I pulled up the numbers this morning to see in terms of what the year-to-date return is for the stock market, as defined as the S&P 500 index. These are 500 stocks in the index. The return is up 15% year-to-date. So just looking from January 1st to today, October 14, the S&P 500 index as of this morning had a total return of 15%. That's a very good return for the stock market. You can do that year after year. You're doing very well. And we're not even done with the year, right? We still have a couple of months to go. So a very good return from the stock market. But what's driving the stock market? If you look at the S&P 500 index, 35% is technology. And the technology stocks are up 24% year to date. So it's really these technology stocks that are driving up the returns for the overall market. And other sectors are pretty kind of flat, kind of normal returns. If you look at the energy sector, it's only up 4% year to date. The consumer staples sector is up 3% year to date. The consumer discretionary is up 3% year to date. So you're seeing flattish returns in the consumer sector, the energy sector, healthcare sector is up 4.6% year to date. So it's up, it's doing okay, but it's not up 15%. It's the if you, it's up much less than that. So if you're overweight as an investor, the healthcare sector, the consumer sector, the energy sector, you underperformed because it's really the information technology sector that has done very well. And so, as an investor, if you overweighted the technology stocks, and most of your portfolio is in technology, then you've done very, very well because technology stocks have increased in value, and there is this expectation that artificial intelligence will lead to new products, and this technology will disrupt many markets. And with that, there's a lot of investments right now in artificial intelligence. There's a lot of investments in the hardware and the chips to power that artificial intelligence. And there's a lot of investments in the power and electricity needed to power the data centers that will power the LLMs, the large language models, for artificial intelligence to be productive. So a lot of investments in this particular sector that's driving up the entire market, where the rest of the market is up a little bit, but pretty much much less than the overall market. So the other sector I'll point out that's done very well this year is utilities. And you get asked, why is utilities up? Maybe it's due to interest rates coming down. Utilities generally go up because they trade on dividend yield, and if you're getting a certain dividend yield on utilities. But really, the other key factor for utilities is actually artificial intelligence, because you need extra electricity, extra power demand to power these data centers. And with that, utilities are a beneficiary because they generate electricity, they generate power for the consumer, but also for these data centers. And with that, the utility sector is up year to date 23%. So the utility sector is outperforming the market. Technology sector is outperforming the market. Most of the other sectors are up a little bit, with the overall market up a very healthy 15% in terms of your investment portfolio. I look forward to any questions on that at the end of the session. The next slide is on inflation, which we defined as the consumer price index, how are consumer prices changing year over year. And it's been below 3%. So the Federal Reserve had a target of 2%, didn't quite come down to that target, but it's been tame. It's been below 3%. We haven't seen a shock. With tariffs in place in April, a lot of economists thought that would lead to higher consumer prices, and you see the shock. And if you have higher consumer prices, higher inflation, that will lead to higher interest rates. That will drag down the fixed income market and also the stock market. But we've seen inflation tame below that 3% threshold at 2.9%. It is still a key risk for the market. In terms of the factors that are out there, this is one factor that could easily bring down the market if you do see the data come in at higher inflation rates. So it's something we're monitoring very closely. You see inflation was very high in 2022 at 9.1%. And because the Federal Reserve increased interest rates, slowed down the economy, we've seen inflation come down since then. And there's a lot of discussion on whether that high inflation was transitory due to COVID, or if it's a new permanent cycle that we're in terms of the long-term inflation rate. Right now, it's at 2.9%, which is an acceptable rate for for both the stock market and the bond market. You can see the breakdown of this consumer price index. It's largely due to the cost of housing. So is your mortgage payment higher? Is your rent payment higher? If it is, then that means inflation is going up. You can also see transportation costs are a big factor. Your car payment is that higher, uh, and also the price of gas to fuel your car, the with 14% also due to food and beverage. So is the price of your groceries higher? And that all leads to a higher aggregate consumer price index level, which is a signal that you'd have higher inflation. So the Federal Reserve looks at this inflation rate and they look at the unemployment rate. They have a dual mandate. One is to keep inflation low, and they want to get it to 2% in the long term, but perhaps they're happy that it's below 3% right now. They also care about unemployment as well. And they'll dictate the lending rate that they have to other banks that then in turn lend to consumers and companies. They'll look at the data on inflation and unemployment and then adjust their own federal funds discount rate. And this is what this slide covers. The federal funds discount rate has dropped to 4.1%. The Federal Reserve will meet towards the end of this month to decide whether it should be dropped again. There's a lot of consensus out there, a lot of expectations that they'll cut interest rates again at the end of this month, another 25 basis points. They tend to like these 25 basis point drops to move down gradually. And then if you do have a shock to the system, they could always move that faster, either down or up. But right now we're at 4.1% for the federal funds discount rate, which is interesting. That first slide was on the treasury yield, which is at 4%. So you look at this short-term lending rate from the Federal Reserve at 4.1% and the longer-term rate of 4%. That's a sign of a slightly inverted yield curve, right? So the yield curve is slightly inverted. That's a leading economic indicator that actually is an ominous sign to the economy. If you have a steep inverted yield curve where short-term interest rates are higher than those longer-term interest rates, then that's a sign that you're going to have a recession in the near future. Right now, the curve is mostly flat. Basically, short-term rates are kind of the same as long-term rates, depending on which duration you're looking at, if it's 3 months or 2 years or 10 years or 30 years. But you're looking at a flattish curve. So it's not too much inverted. If you had these really higher long-term rates than if you had higher short-term rates than long-term rates, that would be an ominous sign for the economy. But right now, we see a flat, overall flat curve. But this is another key monitoring point for us. If the Federal Reserve cuts rates again, that can stimulate the economy. But then we also have to be concerned with inflation. If inflation will pick up or not. So a lot of moving pieces with both the Federal Reserve and also the fiscal policy that we see, obviously, with the government shutdown, how much the government is spending versus how much they're taking in and tax collection, and how that impacts the overall economy, which can impact the overall market as well. So this is another tool that the Federal Reserve has, which is their balance sheet. So essentially, they can insert cash into the economy or take cash out through their balance sheet. Essentially, they're able to buy mortgage-backed securities through IOUs. They're able to buy treasuries through IOUs, and they did a lot of that. They bought a lot of assets when COVID happened in 2020. And some people will say that's why inflation picked up. There's too much cash being inserted into the economy. And since that, they've unwound those positions. So their balance sheet increased to $9 trillion after COVID. That's come down to 6.6 trillion as of this slide. So not too long ago, as of a few days ago, the balance sheet came down to 6.6 trillion. And that's a sign that they're trying to tame that long-term inflation rate. They don't want too much money chasing too few goods, which would increase prices and therefore be ominous for the economy, but also the bond market and the stock market. Here we see this other factor that the Federal Reserve and everyone cares about, which is the unemployment rate, and it's dropped down since COVID. So you had that big spike you can see during COVID on this chart in 2020. You see a big spike where the unemployment rate reached 13%. But since that, it's come down and it's about 4.3% right now. As I checked this morning, as of August this year, it's at 4.3%. Now that's come up since last year. So you see it ticking up a little bit, which is a concern for the overall economy. But it's still well below its long-term average. So it's nowhere near where it is during recessionary points, whether it was during COVID or the Great Recession of 2008, where unemployment really spiked up. And throughout other cycles, you've seen unemployment much higher. So long-term average of 5.7%, and we're at 4.3% right now. But it is a key monitoring point for us. And if it does spike up, it actually would incentivize the Federal Reserve to cut rates as well. So it's one of the data points that moves the the overall discount rate for the stocks that we value, in addition to moving the entire fixed income market. Because if it does come up, the Federal Reserve would have to act faster than we'd expect otherwise. If it does come down and inflation picks up, then we could actually expect the Federal Reserve to keep interest rates relatively high. And we also look at the labor force participation rate. It has been range bound. So the labor force participation rate monitors the amount of people that are working age population, so 16 years or above, that can work and that decide to either work or they're either looking for work. So the ones that are actively participating in the labor market, that's at 62.3% of the working age population right now. And that's down from the 1990s. It kind of peaked at the 1990s, as you can see here, when it reached 67%. It's come down a little bit, but it's been pretty steady since it dropped off after COVID. After COVID, there was some people that decided to leave the participation rate, but then they came back and we've essentially been range bound above 62% of working age population have participated and are participating in the labor force. And I'll also mention the price of oil. The price of oil is actually, as of today, it's at $58 a barrel. So it's come down a bit. This could impact oil producers, the United States being one of them. Uh, U.S. produces 13 million barrels a day. And then you have Russia that produces 9 million barrels a day. So there's some geopolitics that can move this number as well. Lately, it's come down a little bit because OPEC has decided to increase their production. They had some extra capacity that they decided to fill in. They want to make sure that they're taking their market share. And right now, Saudi Arabia produces about 10 million barrels a day, but they have capacity to produce an extra 2 million on top of that. And if they see prices high and they want to take more market share, they could increase production. But right now, we're getting close to the capacity there in terms of world production. The world itself consumes 104 million barrels a day right now. And there is discussion on when that number will peak. So, in the developed world, generally speaking, demand has leveled off or come down, where in the developing world, there continues to be increased demand for energy with and transportation, with the price of oil being impacted by that. So it comes down to supply and demand. We're about 104 million per day of barrels of supply and demand, with with a shift towards electric vehicles, that demand would drop. But we'll see when this peak will happen, this discussion and debate on whether there'll be continued long-term demand for oil, or if that'll come down over time with it being a finite resource. So this is a number that will impact your energy sector, your energy holdings, and it could also impact the overall health of the economy if transportation costs are high, and that means inflation is high. This slide right here is on leading economic indicators, which comes from the conference board. They take 10 leading economic indicators and group them together. We saw the S&P 500 index was up over the past year, and that's actually one of the 10 leading economic indicators. That's a sign the economy is going to do well. That stocks are up. Essentially, they're pricing in good economic news over the next year, and there is a lot of investments in artificial intelligence driving the economy. So that's a positive leading economic indicator. But looking at the 10 on an aggregate basis, we're still at the negative level. I mentioned the yield curve. If it's inverted, it's an ominous sign for the economy. And that's one of the 10 leading economic indicators here. What we're seeing is consumer expectations for business conditions being very poor. And that's the leading economic indicator. And that's one of the reasons why it's below zero. So it is a signal that you'd have an upcoming recession. You can see in the past, these indicators have been very good at predicting a recession in terms of their track record. We are seeing also the new order index for factories ordering new goods. That's also a negative number. And on the next slide here, you can see building permits. Building permits are a leading economic indicator. If they're negative, it means that construction companies aren't building new homes. They don't expect people to buy these new homes, so they're not applying for the permit. And if they don't apply for the permit, then that can weigh on the overall economy. They're not investing in the economy, essentially. And we've seen these new building housing starts come down from that 1.5 million per month range that we saw over the past a couple of years. So it's ticking downwards a little bit. We have mortgage rates that are a little bit high right now. If that comes down, then that could help stabilize this number. If mortgage rates come down, there's more incentive to buy a home, and with that, there's more incentive for a construction company to take that risk on building a home and applying for this permit. So higher mortgage rates definitely impact the housing market, and we'll see if mortgage rates can come down with interest rates, and how that would stabilize the housing market and lead to an increased number of permits per month, which would be a benefit to the overall economy. So this is a key monitoring point for us because it can impact the health of the overall economy, which can impact the health of the overall stock market.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.